The day your investments earn more than your job feels like the finish line. Research suggests it might actually be the beginning. So why do experienced investors consider this moment more important than becoming a millionaire? To answer that question, we need to examine one of the most misunderstood transitions in personal finance. The moment when labor stops being your only source of growth and capital begins to take over. For most of human history, wealth came from work. Farmers worked the land. Blacksmiths worked their tools. Merchants crossed dangerous trade routes carrying goods between cities. No matter where you look, the principle was the same. Income required effort. Stop working and the income stopped too. For thousands of years, this was simply the reality of economic life. But modern investing introduced a strange idea. What if accumulated capital could eventually grow faster than the person who earned it? Today, we'll examine the research, the mathematics, and the psychology behind that transition, and why the day your money starts working harder than you do is not the end of the journey. It's the moment the journey changes completely. In 2013, French economist Thomas Piketty published one of the most discussed economic books of the 21st century, Capital in the 21st Century. At the center of his work was a simple distinction. There are two primary sources of wealth. The first is labor, the second is capital. Labor generates income only while you continue working. Your salary, your wages, your consulting fees, your bonuses. Capital works differently. Stocks generate returns. Businesses produce profits. Real estate generates rent. Bonds pay interest. Capital has the unique ability to create additional wealth without requiring continuous effort from its owner. At first glance, this distinction seems obvious, but over long periods of time, it becomes incredibly important. Imagine an ordinary 25-year-old professional. Every morning, they wake up and go to work. Every dollar they earn comes from their time, skills, and effort. Their entire financial system depends on a single asset, themselves. If they get sick, income may decrease. If they lose their job, income may disappear entirely. If they take an extended vacation, earnings slow down. This is why many young professionals possess high earning potential but relatively low financial resilience. And this is exactly where investing enters the picture. The idea seems almost magical. Instead of spending every dollar they earn, a person begins setting aside part of their income. They buy stocks, index funds, bonds, real estate. They sacrifice consumption today in exchange for the possibility of greater wealth tomorrow. Yet nearly every new investor encounters the same problem. The results are disappointing, at least in the beginning. Suppose an investor accumulates $5,000. Historically, the S&P 500 has returned roughly 10% annually over very long periods, although actual yearly results vary significantly. At that rate, $5,000 produces approximately $500 per year. That's just over $1 per day. Most people barely notice it. At this stage, labor still appears infinitely more powerful than investing. Your job earns hundreds of dollars. Your portfolio earns one. The comparison feels almost ridiculous. And yet this is where one of the most important mistakes occurs. People abandon investing because they expect immediate rewards from a system designed to operate over decades. Behavioral economists Daniel Kahneman and Amos Tversky spend years studying how humans evaluate gains and losses. Their research repeatedly demonstrated that people focus heavily on immediate outcomes while struggling to appreciate long-term effects. We notice today's gain, we notice today's loss, but we have difficulty emotionally understanding something that compounds over 20 or 30 years. This psychological bias helps explain why investing feels so unrewarding during its early stages. The future is being built, but it is being built so slowly that most people cannot see it. In investing circles, there is a famous statement commonly associated with Charlie Munger. The first $100,000 is a bit. Interestingly, Munger wasn't talking about becoming a millionaire. He wasn't talking about financial independence, and he certainly wasn't talking about retirement. He was talking specifically about the first $100,000. Why? The answer is surprisingly mathematical. Below a certain level, portfolio growth comes primarily from your contributions. You work, you earn money, you invest part of it. Your labor remains the dominant engine. But eventually something begins to change. Imagine an investor who accumulates $100,000. Using the same historical 10% annual return as a rough long-term benchmark, that portfolio could generate around $10,000 per year. For the first time, capital becomes noticeable. The portfolio is no longer symbolic, it is participating. Many investors describe this milestone as the moment they first feel their money helping them. Not theoretically, not emotionally, actually helping. And this is where our story becomes interesting, because the next stage doesn't just change numbers, it changes psychology. Imagine a 35-year-old investor. One morning, they open their brokerage account. The market had a good day yesterday. Their portfolio increased by $400. Later that day, they go to work and earn $250. The next day, the market rises again. Another $300. A few days later, $500. For the first time in their life, something strange happens. Their investments begin generating more money than they do. Not over a year, not over a month, in a single day. At first, this sounds like a dream. After all, isn't this the entire purpose of investing? But research and experience suggest something more complicated. A new question emerges. If capital can earn more than I can, why am I still working? At first, the answer seems obvious. For money. But once money begins appearing independently of your labor, that answer gradually loses its power. In 1930, British economist John Maynard Keynes published an essay titled Economic Possibilities for Our Grandchildren. In it, Keynes predicted that technological progress and productivity growth would eventually reduce humanity's need to work. He believed future generations might work dramatically fewer hours because economic necessity would become less important. Nearly a century later, we can say his prediction was only partially correct. Productivity increased, technology advanced, capital became incredibly powerful, yet people continue working, often just as much as before. Why? Because work serves functions beyond income. Research in organizational psychology consistently shows that work provides structure, social connection, identity, purpose, and a sense of progress. Money solves financial problems, but it doesn't automatically solve existential ones. This creates a fascinating paradox. The more successful an investor becomes, the more likely they are to encounter questions that money alone cannot answer. To better understand this phenomenon, consider one of the most famous examples in investing history, Warren Buffett. Buffett is widely regarded as one of the greatest investors of all time. Yet one statistic surprises almost everyone. The overwhelming majority of Buffett's wealth was accumulated after the age of 50. Some estimates suggest that more than 99% of his net worth arrived later in life. Did Buffett suddenly become smarter after turning 50? Did he discover secret investment techniques? Did he gain access to hidden opportunities? Not really. The answer was compounding. Year after year, capital generated returns. Those returns generated additional returns. Those returns generated even more returns. Each year built upon the previous one. This is why many investors consider time the most undervalued asset in finance. When people discuss wealth, they usually focus on the size of a portfolio. Rarely do they discuss its age. Two investors may have identical portfolios today, but the investor who has allowed capital to compound longer often possesses a dramatically more powerful financial machine. The process resembles a snowball rolling downhill. At the top of the hill, it appears insignificant. As it moves, it gathers mass. Eventually, it becomes impossible to distinguish the original snow from everything added afterward. Capital behaves similarly. During the early years, your contributions dominate growth. During the later years, growth itself becomes the dominant force. And this is why the day your investments earn more than your job represents such a significant psychological milestone. It signals the activation of a second engine. But there is another side to the story that receives far less attention. Most people underestimate the emotional challenges of wealth. Imagine a portfolio worth $1 million. Now imagine the market falls by 2% in a single day. On paper, you've lost $20,000. For many people, that's more than an entire month's salary. Research by Daniel Kahneman demonstrated that losses tend to feel psychologically stronger than equivalent gains. In simple terms, losing $10,000 hurts more than gaining $10,000 feels good. As wealth increases, emotional volatility often increases as well. Large portfolios create opportunities, but they also create responsibility, uncertainty, pressure. Eventually, investors discover that building wealth and living with wealth are entirely different skills. The first requires discipline, the second requires maturity. Many people dream about the day their money begins working for them. Few stop to consider what happens afterward. Imagine opening your investment account tomorrow. Your portfolio gained $1,000 today. Next week, another $1,000. Next month, several thousand more. At first, it feels extraordinary. Then it feels normal. Psychologists call this adaptation. Humans adjust surprisingly quickly to improved circumstances. What once felt impossible eventually becomes ordinary. This helps explain why financial goals continuously move. $100,000 becomes $200,000. $200,000 becomes $500,000. $500,000 becomes $1 million. $1 million becomes $2 million. The horizon keeps moving away. And this reveals one of the most important lessons in investing. Capital is not the destination. Capital is a tool. It can purchase freedom, it can create security, it can provide choices, but it cannot automatically tell you how to use those choices. Ultimately, the day your investments earn more than your job matters for reasons that have very little to do with money. It matters because it changes your relationship with wealth. Before that day, you are the primary engine of your financial growth. After that day, a second engine begins operating alongside you, your capital. Sometimes it works slower than you. Sometimes it works faster. Sometimes it keeps working while you sleep. This is why experienced investors speak about compounding with almost religious respect. They understand that the true power of investing does not come from predicting markets. It does not come from finding the perfect stock. And it does not come from a lucky trade. The true power comes from time. Time transforms capital from a tool into a system, from a helper into a partner, from accumulated money into an independent mechanism capable of generating more wealth. And perhaps the most important conclusion from this entire discussion is this. Most people believe the purpose of investing is to stop working. History suggests something different. The real purpose is not replacing labor with capital. The real purpose is creating choice. Because wealth is not measured by the amount of money you have. Wealth is measured by the number of options available to you. And the day your investments earn more than your job may be the first day those options truly begin to appear.